Let's start where else? The markets closing lower today, still hovering at an all-time high, even as risk-off trades roar. Check it out. The S&P up 17% this year. Meanwhile, gold and bonds are booming. So can these assets continue to rally together? And what should you be buying? You take that first question.
Well, that song, guys. I thought it was the Loving Spoonful.
How about the Turtles?
The Turtles. Get a little ding-ding. Nice job by Tim. Welcome.
Thank you.
We love it when you're here. Thanks for being here. I know it's a long day. What was the question? Oh, no, I know what the question was. Listen, I am a skeptic of the market. I've been a skeptic, and the S&P goes up every day right in my face. But with that said, and you can rage against the machine, but in a market where utilities continue to make all-time highs, names like Procter & Gamble, now at 24 times forward earnings, continue to make all-time highs, you have to ask yourself, is this a sign of a healthy, broader market? I say no. The answer to your question, where can you still be? I'll say it again, and we haven't just said this in a vacuum over the last week. We've been saying it for a while. Something is happening in the gold market without question. It's a function of what's going on with central banks globally, and these gold mining stocks are breaking out to the upside. They continue to have room, Scott.
So a healthy market, I'm not even sure. So it's a great question because I think there's a lot of things that should be flashing caution out there. Look, we had a Dallas Fed report that followed a Philly Fed and New York Fed that were horrendous numbers, 3-year lows on these volatile but very important manufacturing regional Fed indices. Look at dollar yen, another sign of risk, which is blinking, basically breakdown. In other words, yen is outperforming the safe haven trade being unwound or a carry trade. Look at where yields are. Look at where gold is. I mean, gold's outperformance of silver is a function of really people running for not just precious metals, but running for risk aversion. Last time you saw this was in the 90s. So there's all kinds of things you can point to. But what is a healthy market is really the question, because frankly, if you own Coca-Cola and Pepsi, and if you own Procter & Gamble, and if you own McDonald's and Starbucks, these are defensive stocks that are probably going higher, and the valuation almost doesn't even matter.
But Danny, what does it say when you have staples hitting new highs, bonds going up, gold going up, Bitcoin going up, stocks going up? What's the message in that?
It's really simple. I mean, the warning signs are screaming in silence. They're right out there. And if you're just looking at the S&P 500 that just made a new all-time high, you're looking at the wrong thing. If the Fed's telling you they're going to lower rates because they want to get inflation going, 10 years of ZIRP and QE and all that stuff tells us there's no way to get any real low rates or no inflation. And the only thing that's inflated is the S&P 500. That chart there, that's a little fun here. The last two times we saw the Fed go down these rate-cutting cycles, we saw where the S&P 500 topped out around 1600s. It got cut in half both times. You take the average strategist on the street, what their targets are, about 3,000, 30, 50 or something like that. You take a 50% hit to that, you get right back to that support at 1600. I'm not saying that's going to happen, but it looks nice on the charts.
Trying to scare people.
Well, a little bit, because you know what, Tim, we got guys, everyone coming out saying how great the economy is. The only thing that's actually doing well is the S&P 500, and the stock market is not the economy.
Well, if you look at the underlying figures, Tim mentioned a couple of the Federal Reserve indices. You look at what's going on with transports. We're going to talk about those later. But the economy and the global economy, more importantly, does not look that great. There are signs of weakening. We have a lot of reports coming out later this week. ISM, PMIs, those will likely turn lower. And here's the thing. Take the playbook from Japan in the mid-2000s, okay? This was after they already tried multiple cuts, QE, QQE, then they cut near to the lows, and the Japanese stock market did not respond. At some point in time, you hit the law of diminishing returns, and that's where we are.
Are you saying that's what's going to happen if the Fed cuts rates?
I think
the market is not going to respond the way people think.
I think there's a very good chance, a non-trivial chance, something you need to be prepared for, that the Fed cuts rates in July and the market goes down.
So, all these leading indicators are telling you, as they should, to be careful that the economy is not where it was a year and a half ago. But how bad is it? So, really the question is, you're getting some concern out of Europe that actually their employment numbers are going to start to break down. For an economy that's really an export economy, the consumers held them up. What's happening with peak labor here? It's hard to argue we can get a lot better on payroll. So the consumer is going to be resilient. The economy, for whatever you want to say about a rear-looking measure in GDP, the economy has been growing, 2 to 3% for the last four quarters. It doesn't show as if it's about to fall off a cliff. The question is, if the Fed is getting out of your way and you have trend or slightly below trend growth, shouldn't the market be able to get in its own way here and continue to do what it's doing? I kind of
well, that's the question, though. Are we going to have trend growth, or are things going to stall? That's the biggest question that the market's trying to answer. And if you look at some of these kind of leading indicators, things are starting to roll over. So the only caveat I would say, if we get some movement, and it have to be significant movement at the G20 towards some kind of truce in this trade war, then you could actually see the market hit new highs. It may be irrational, but that's the one thing that we're set up for right now.
So, Beeks, what breaks it out, though? That is, you talk about what's been acting well, and it's all these defensive names, utilities, REITs, staples.
That's not the only thing that's been acting
well. I know, but so let's just look at MAGA. You got your FANG, I got my MAGA. That's Microsoft, Apple, Google, and Amazon. When you think about it, Microsoft is making new highs. Whoa, what the heck is that? Almost every day.
I've never even seen that.
That's a brand new graphic
That's new. That's hot.
Is that you in the graphic?
Yeah, it was.
Yeah.
You see that blue hat? That's real good. Listen, Microsoft is acting like a defensive name. People are crowding into it. But then when you think about what did we see out of Salesforce? What did we see out of Oracle in the last couple weeks? And Adobe, that's telling you that enterprise spending on some of this stuff is still pretty good, right? So we know that we talk about the U.S. consumer a lot. That's great. But here's the thing. Back to the market. If the market's going to break out to meaningful highs, you're going to need Apple, you're going to need Google, and you're going to need Amazon getting back towards their prior highs. And I'm just not certain that you can get $2.5 trillion of market cap that has plenty of headwinds, ex-trade related to them, to be that torque to get the market to break out.
You know what else you're going to need, Scott? In my opinion, you're going to need the small caps as measured with the IWM. And in September of last year, this IWM was 175 when the S&P 500 was making its all-time high. But guess what? With the S&P 500 effectively at all-time highs again, we're nowhere near it in the Russell. So if things were gangbusters, I think if the market were as strong as everybody wants to believe, I think the Russell would be higher. And to answer your original question of what does it tell you that every asset...
7.5 minutes in, you're finally going to get...
No, I answered your first question, but then you asked another question, which I'm answering now because it's coming around to me again. What does it tell you with all these assets going higher? It says to me the Fed is looking at inflation in all the wrong places. Inflation is right in front of your face, and it's manifesting itself in all these assets.
Let me throw another question out there to you, BK.
Let's do it.
Make sure you don't take 7 minutes to answer it.
Are you negative, or are you just afraid to be positive because of all of the risk factors that are out there?
I would say that I'm cautious because we've had such a run. We have been in a trading range for a year. It's been a big trading range. We're at the top of the trading range. There are signs out there that things are not as great as maybe an S&P 1% away from the high or at all-time highs suggest. So what I'm saying is I'm cautious. I don't have a lot of equity exposure at this point in time. I don't think you need to. I think you can buy puts if you want to hold on to your stocks. But I think there's certain times, and in this market, what we've had for the last year, there are certain times you just need to be a little bit cautious. That's what I would say.
Did he answer the question?
Yeah,
I don't really think he did.
I said it cautious like 8 times. I'll say it again.
So how about this? How about structurally cautious but tactically optimistic? And I've said this now like 3 times in the last week, and I'm going to keep saying it until somebody listens.
That one up me.
The bottom line here is you have a handful of dynamics from the market, which is at all-time highs. Okay, and I realize that people don't like the quality of what's at all-time highs, but they're some of the greatest companies in the world that right now are at all-time highs. And these are companies that when markets were also at a low-growth standard, we're not doing it. I mean, Coke had underperformed for years. When we were in 2014, 2015, and we were kind of going through this Fed-induced NERP environment, and people were wondering, well, what happened to these great companies? These great companies are now actually chugging along at all cylinders. They look very healthy, free cash flow generation, et cetera, et cetera. So, I mean, I think you just have to take the market that is with you and not get carried away and say everything is perfect, because there are a lot of issues out there. But the reality is,
it's
right
far
now,
from perfect, but it's
the
also
consumer
far from
is
bad.
spending.
I think it's closer to bad than perfect, but that's what makes markets.